Shelf Corporations, Secrets Revealed. To understand where shelf corporations fit into the corporate credit world, we must first talk about what business credit is and how it works. Business credit is credit that is for a business and is in the business name. With business credit, the business builds its own credit profile and credit score. With an established credit profile and score, the business will then qualify for credit. This credit is in the business name and based on the business's ability to pay, not the business owner's. Since the business qualifies for the credit, in most cases, there is no personal credit check required from the business owner. The business can use its business credit profile and score to qualify for revolving credit cards like Staples, Lowe's, Sam's Club, Costco, BP, Walmart, and many more. The business can also qualify for Visa, Amex, and MasterCard. The business credit profile will also help the business qualify for secure and unsecure business credit lines. The business can also qualify for some funding, loans, and some with no personal guarantee required from the business owner. Having established business credit provides a ton of benefits to a business owner. One big benefit is that with business credit, a credit profile can be built for a business that is completely separate from the business owner's personal credit profile. This gives business owners double the borrowing power as they have both personal and business credit profiles built. Another benefit of business credit is that approvals are based on a business's ability to pay, not the business owner's. Since the business qualifies for the credit, in some cases there is no personal credit check required from the business owner. Yet another benefit of business credit is that business credit scores are based only on whether the business pays its bills on time. So a business owner can obtain credit much faster using their business credit profile versus their personal credit profile. A business credit report can be started much the same as a consumer report commonly is, with small credit cards. The business can be approved for small credit cards to help them build an initial credit profile. These types of initial cards in the business world are commonly referred to as vendor credit. A vendor line of credit is when a company, vendor, extends a line of credit to your business on net 15, 30, 60, or 90-day terms. This means that you can purchase their products or services up to a maximum dollar amount, and you have 15, 30, 60, or 90 days to pay the bill in full. So if you're set up on net 30 terms and were to purchase $300 worth of goods today, then that $300 is due within the next 30 days. You can get products and services for your business needs and defer the payment on those for 30 days, thereby easing cash flow. And some vendors will approve your company for net 30 payment terms upon verification of as little as an EIN number and a 411 listing. Always apply first for business credit without using your Social Security number. Some vendors will request it, and some will even tell you on the phone they need to have it, but submit first without it. When your first Net 30 account reports your trade line to Dun & Bradstreet, the DUNS system will automatically activate your file if it isn't already. This is also true for Experian and Equifax. You need to have a total of at least 5 Net 30-day pay accounts reporting. Some vendors require an initial prepaid order before they can approve your business for terms. Your vendors do not necessarily have to serve 100% of your business needs. Make sure you pay your Net 30 vendor accounts in full and on time. You must be patient and allow time for the vendors' reporting cycles to get into the reporting systems. It typically takes 3 cycles of net accounts reporting to build credit scores. Now, let's dive in and discuss how shelf corporations fit into the business credit world. A shelf corporation is a paper or shell corporation that is administratively formed and then put on a shelf for several years to age. The term shelf or aged only refers to the fact that the company has already been filed and is sitting on a shelf waiting to be purchased. A shelf corporation is a company that was created years ago for the sole purpose of being sold in the future simply for the value of its age. A person forms a company and does nothing with the corporation other than file the annual reports and cover the annual fees. Once the corporation is a few years old, it has a sort of value for the right person. Historically, shelf corporations were considered a legitimate way to streamline a startup. They were especially useful prior to the introduction of electronic registration when setting up new corporations used to take months to do. Selling them as a vehicle to get around credit guidelines is fairly new. Shelf corporations are also called aged corporations, seasoned shelf corporations, off-the-shelf company, shelf corps. They are not the same as shell corporations. Shell corporations are completely different entities, both in scope and in formation. Usually have no significant assets or operational structure. A shelf corporation doesn't engage in any real business. Most shelf corporations have been totally inactive. They have never had income, assets, or bank accounts, or had operations or activity of any kind. During the aging period, some efforts may be undertaken to establish a credit history, file basic tax returns, open a business bank account, and other simple actions to demonstrate some activity. These type of shelf corporations are more valuable and are sold for more money. Shelf corporations are legal and do have legitimate purposes. They have been used by someone who may not otherwise qualify for a bank loan, line of credit, or government contract because they or their existing company do not have the required credit scores or a 2 to 5 year established business history. Some benefits of shelf corporations include that a long-established company might qualify for more credit and funding. For example, a company that has been open for 10 years will look more credible than one just opened this year. This might help to secure more credit and funding as the majority of businesses fail within 4 years and only a small percent make it to 10 years or more. Shelf corporations may be more attractive to potential investors and investment capital. They may or may not have faster and easier access to borrowing. Some trade accounts will only approve companies who have been opened for 1 to 3 years or more. Buying a shelf corporation can make it easier to qualify for a loan, especially if you apply for less than $150,000. Most banks do not perform extensive investigations for loan amounts less than $150K. But it's very important to note many banks still see shelf corporations as unethical, as many use them to rack up credit and never pay the bills. When you purchase a shelf corporation, in some cases, you are purchasing a turnkey business. The company can then be sold to a person or group of persons who wish to start a company without going through all the procedures of creating a new one. By purchasing a shelf corporation, an entrepreneur now instantly owns an established company that has been in business for several years without debts or liabilities. A major benefit of shelf corporations is that you have an instant history for a company. You also improve the company image. Plus, it's much faster to pursue business endeavors because the company is already formed and ready for immediate delivery. It's also faster to obtain business licenses with shelf corporations than brand new startup businesses. A current and major benefit of shelf corporations is that you have a faster ability to bid on contracts. They also save you time by foregoing the time and expense of forming a brand new corporation. And you get the extra benefit of corporate filing longevity. A company is founded when they initially set up their corporation. Many potential business resources are hesitant to engage brand new or upstart corporations. The age of your company can give greater credibility to customers and lenders than a business that was recently established. For example, let's say you were an accountant for 10 years, but just opened your business. By buying an aged corporation that has been open 10 years, you can then advertise that you have been in business for 10 years, and your corporate records also support that. Shelf corporations are frequently used for holding personal or business assets. They are also used to show corporate longevity in order to attract consumers or investors. Another use of shelf corporations is to gain access to corporate credit. Shelf corporations are commonly used to gain the opportunity to bid on contracts. For example, some jurisdictions require that a company be in business for a certain length of time to have this ability. Often, people purchase such shelf companies in Nevada, Wyoming, or California, as well as Delaware, due to regulatory considerations. When you purchase a shelf corporation, there are typically many things you will receive, including articles of incorporation, action of sole incorporator document which transfers the company to you, minutes of meetings, blank sample forms, a corporate kit, record book, stock certificates, blank unissued shares. You will also receive a corporate seal, corporate bylaws, unsigned forms, registered agent service, federal tax ID number. Before you jump in and purchase a shelf corporation, there are many drawbacks you should know about. Shelf corporations are not looked upon favorably by regulators, lenders, or the business reporting agencies. Many say they are unethical, borderline illegal, and some call them a fraud. This excerpt comes directly from Dun & Bradstreet. It is unclear whether it is legal to use shelf corporations to access credit. It is clear, however, that this is a deceitful, unethical maneuver that serious entrepreneurs should avoid. One big drawback of shelf corporations is that if the credit bureaus learn about the company being under new management, they will list it on their reports, effectively re-aging the company. The following comes directly from a FDIC special alert on April 24, 2009. Shell and shelf companies can be created domestically or in a foreign country. Shell and shelf companies are often formed by individuals and businesses to conduct legitimate transactions. However, they can and have been used as vehicles for common financial crime schemes such as money laundering, fraudulent loans, and fraudulent purchasing. By virtue of the ease of formation and the absence of ownership disclosure requirements, shell and shelf companies are an attractive vehicle for those seeking to conduct illicit activity. Due to shelf corporations existing, many lenders now look at the bank account start date as the corporation start date. But most shelf corporations don't come with established bank accounts, costing you one of the main benefits shelf corporations are supposed to provide, which is corporate seasoning. Some shelf corporations even have actual credit problems, making it harder to get funding, not easier. Most lenders know what to look for to see if the corporation is a shelf corporation. Things like your business bank rating could tip them off. Public records also show the change in ownership, which raises red flags. Besides all of these drawbacks, there are even more negatives that you must consider before thinking about investing in a shelf corporation. Shelf corporations are expensive. Some companies might charge $500 to $6,000 for the company. Some companies even charge $20,000 or more. Your actual cost depends on how long the company has been opened. It's also crucial that you keep in mind that if you purchase the shelf corporation, you are now the owner and responsible for anything bad that may have happened with the company since the day it was incorporated. This includes back taxes, financial audits, lawsuits, and judgments that might be associated with that corporation. Shelf corporations really aren't needed in business credit building. Most vendors will approve new businesses for credit, even if they just opened. The key is to know which vendors can help a brand new business and which ones can't, not trying to buy an already established business. Shelf corporations are not necessary to build business credit. Using a shelf corporation is not even the best way to build business credit and could create severe roadblocks for you along the way. Due to their expense and potential issues, they can actually hurt you more than they can help. The best way to build business credit is to work with vendors who approve new businesses, as many do. The best way to get funding is to use collateral or have your business generating cash flow. Other ways to get funding are to use good credit partners to obtain unsecured financing. Contact us today to learn more about building your business credit without paying for an expensive shelf corporation and to learn more about the real truths behind shelf corps before you invest in one.